In the early 17th century, the Dutch Republic was the wealthiest nation on earth. Through the Dutch East India Company, money flowed into Amsterdam like never before. With gold in their pockets, the Dutch elite began looking for ways to signal their status. They didn't just want art or jewelry, they wanted something rare, something exotic. They found it in the tulip. Tulips had been imported from the Ottoman Empire. They were unlike any flower Europeans had seen. Their colors were vibrant, deep, and sometimes streaked with bizarre, flame-like patterns. Today, we know those streaks were caused by a virus transmitted by aphids, but to the Dutch, they were signs of supernatural beauty. The rarer the streak, the higher the price. By the 1630s, tulip bulbs weren't just flowers, they were investment vehicles. Traders began buying bulbs, not to plant them, but to hold them until the price rose so they could sell them to someone else for a profit. This is the classic definition of speculation. The utility of the object mattered less than the belief that someone else would pay more for it tomorrow. The craze moved from the wealthy elite to the middle class. Weavers, bakers, and farmers began liquidating their businesses, selling their cows, and mortgaging their lands to enter the bulb market. It felt like a shortcut to infinite wealth. Why work a trade when a single Semper Augustus bulb could fetch the price of a grand estate on the canal? As prices climbed, the market became professionalized. People started trading wind handle, or wind trade. Since bulbs could only be moved during specific seasons, traders began signing contracts to buy bulbs at a future date. They were trading pieces of paper that promised delivery of a flower they hadn't seen, at a price that hadn't been fully paid. By 1636, a single bulb could cost thousands of guilders. For context, a skilled craftsman at the time might earn 150 to 300 guilders in a whole year. This meant a single flower bulb was priced at 10 years of wages for a working person. The market was completely untethered from the actual value of a plant. The psychology of the bubble was simple: fear of missing out, or FOMO. When a neighbor gets rich overnight, you don't ask if the investment is sound, you ask how you can get in. As more people entered the market, the price kept rising, which served as proof that it would keep rising forever. This is the self-reinforcing loop of all financial bubbles. But bubbles require a constant supply of new buyers. In February 1637, that supply finally hit a wall. At an auction in Haarlem, for the first time, there were no bidders. Someone tried to sell a high-value bulb, and the room remained silent. Panic spread like wildfire. If you couldn't sell today, how would you pay the debt you took on yesterday? The realization hit the market instantly: these were just flowers. The contracts that were supposed to make everyone rich were now just expensive promises to buy rotting plant matter. Traders tried to offload their bulbs at any price, but there were no buyers left. The liquidity, the ability to turn assets into cash, vanished in a single afternoon. The aftermath was messy. Courts were flooded with lawsuits from people trying to break their contracts. The government eventually intervened, effectively nullifying most of the speculative agreements. Many who had traded their homes and businesses for bulbs were left with nothing but a garden of common flowers that were worth pennies compared to their original cost. Historians have debated the severity of the crash for centuries. Some argue it caused a nationwide depression, while others suggest it was a localized disaster that primarily hit the nouveau riche. However, the event remains the gold standard for studying market psychology. It proved that markets, no matter the era, are driven by human emotion as much as by data. The lesson of Tulip Mania isn't just about flowers. It's about the greater fool theory. This theory suggests that you can make money on an overpriced asset as long as there is a greater fool willing to pay even more for it. The problem is that eventually, the market runs out of fools, and the last person holding the bulb pays the ultimate price.